I'd like to thank TradersWorld Expo for inviting us to participate. We're excited to be a part of the event this year. And we're going to focus our presentation on swing trading in commodities. In a nutshell, swing trading is basically doing exactly the opposite of what human nature wants us to do. Most of us, anyway, are built to want to buy into a market that's going up and sell into a market that's going down, but that's not always the best choice. In fact, a lot of times it's the exact opposite thing that we should be doing, but that is by nature what we like to do. So anyway, what we're going to talk about is an unconventional approach to speculation and risk management. If you don't know who I am, my name is Carly Garner. I am a broker at DeCarly Trading in Las Vegas, Nevada. Should clarify that, a commodity broker, so we handle futures and options. If you have any questions, comments, or concerns about anything that we talk about in this video, please feel free to give me a call or send me an email. I'd love to hear from you. Also, if you're on social media, check us out. If you just search DeCarly Trading in Facebook, we'll come up. We're also on Instagram. And on Twitter, my handle is @CarlyGarner. We like to post a lot of market commentary, charts, informational articles, events, webinars, that sort of thing, so check it out. Just a little quick blurb about me. Again, I am a broker, but I'm also a strategist and an author. I write a monthly column for Stocks and Commodities magazine. I also write a couple of newsletters for our brokerage clients, which are daily, or at least almost always daily. And they cover commodity markets, the financials, currencies, crude oil, grains, you name it, we talk about it. And I've also written 4 books on trading commodities, or at least trading futures and options, same thing. The latest book is Higher Probability Commodity Trading. It's available at any major book outlet, but cheapest on Amazon. Today, in our video, we're going to be talking about some of the things that I cover in this book. And before we get started, I just want to remind everybody there is a substantial risk of loss in trading futures and options. Trading is not suitable for everybody. This is not an investment. It is a speculation. With that said, commodity trading can be as aggressive or as conservative as you want it to be. As a trader, you decide how much leverage you use or don't use. And unfortunately, most people push their limits. They use the absolute maximum leverage that's allowed to them, and that's generally a recipe for disaster, but that's just what we do. It's kind of like I live in Las Vegas. There's lots of buffets here. You know, it's impossible to go to a buffet and eat a reasonable amount of food. It's just not in our nature. We want to eat as much as we can, get our money's worth, so to speak, and the markets are the same way. So a big secret to success in trading commodities is learning how to control your emotions and control your ability to manage leverage. In short, just take it easy. Let's talk about going against the grain. And again, this is exactly the opposite of what most people are comfortable doing. The question is the trend really your friend? We hear that a lot. The trend is your friend. I would argue that perhaps it is not. Sometimes it is, but it usually is not. And we'll show you a few reasons why we think that might be the case. Warren Buffett said it best: be fearful when others are greedy, and greedy when others are fearful. Unfortunately, most retail traders lose money. And how they lose money is basically chasing markets. When you're chasing prices, you are bound to lose. It'll work sometimes. I would venture to say, you know, maybe 10, 20%, or if you're lucky, 30% of the time, it might work to chase a market higher or chase a market lower. But more often than not, just as you're starting to get bullish, the market itself will probably reverse and go the other way. If the herd is bullish, it might just be a good time to get bearish. A common assumption that beginning traders tend to make is that the highest probability trading strategy is trend trading. Unfortunately, making money in the market is not as easy as identifying the trend and jumping on the bandwagon. It's absolutely not that easy. It seems like it would be. Trust me, I talk to a lot of beginning traders that are paper trading or simply just following charts, and you know, they say things like, well, it's going up, we obviously should buy and catch the ride. Well, the problem is most retail traders kind of think the same because we're all built relatively the same. And the problem is once all of those people finally do decide that the trend is confirmed and they're comfortable buying, that's really about when the buying dries up and the market reverses. Believe it or not, trend traders face lower win percentages and bigger losses than other types of traders, such as counter trend traders, which is what we're going to talk about, which is essentially swing trading. Trend traders, although they do have low win percentages, they actually have the potential for big winners, and that's why people trend trade. We'll show you a chart in a couple of minutes that will give you an idea of just exactly what we're talking about. Trend traders might get chopped in and out several times for big losses, but when they do catch a ride, it can be huge. Trend trading is popular because it's comfortable. Again, it's in tune with human nature, but the thing is, if most traders are comfortable doing something and most traders lose, maybe we should take the other side of that argument and just accept the fact that most people lose. So following what everybody else is doing or what everybody else is comfortable doing might not be the best course of action. The thing about trend trading is you can make a lot of money, but very few people can do it, and here's why. Trend trading takes substantially deep pockets. It takes nerves of steel, and it takes extraordinary patience and discipline. If you don't believe me, let's take a look at this simple example. Trend traders, again, they're forfeiting a higher win percentage, and they're doing that in order to give themselves a chance to make a really big profit when the signal does work out. Not all trend trading systems are built the same. I would guess to say that trend traders probably lose anywhere from 70 to 90% of their trades. But when they do make money, they do so in a big way. And here's exactly what I'm talking about. This is an example of crude oil, and we all know that crude oil over the last couple of years has been, at one point it was in complete free fall is the only word for it. So trend traders actually caught a couple of really big moves. But in order for them to get those moves, they probably suffered some pretty big losses. And to be honest, most people wouldn't have stuck around long enough for the strategy to work. So for example, if you look here, March of 2015 or so, a trend trader probably, now keep in mind, trend traders are always late to the party. They always get their signals late. And again, not all trend traders are using the same system. They're all generally using moving averages or some sort of X number of closes over the average or so on and so forth, but they almost all have the same characteristic of getting into a trend late. And this is because trend traders are trying to catch the big move. They want to confirm that the market's going the direction they think it is before they get long or get short. Fortunately, a lot of them tend to get long at the worst time and short at the worst time. But you can see this particular example. A trader might have gotten a short signal right at the worst time. They would have sold somewhere. The other thing to keep in mind about trend trading is trend traders use deep stops. And when I say deep, I mean really deep. It would not be out of the ordinary for a trend trading system going short here in the $58 range. See, we're around 58. To have a stop loss somewhere up here over the old high around 62, maybe even higher. But right there, that's a $4,000 loss. So this false signal, boom, $4,000 of a loser. This long signal, it looks like it might have worked out in the beginning. They get a signal here. They might make a grand or two on the way up, but the thing again is trend traders trail their stops, but they trail them really, really deep. So most likely this trade, even though it worked out temporarily, probably came back and stopped the trader out at a loss or break even, best case scenario. Here we go again. We might have gotten a long signal here, and depending on where the stop was, might have lost a good $2, $3, $4,000. Again, these are just generalizations. If you were a trader and let's say you had a $20,000 account and you had a 50 to 60% drawdown on these first three trades, you probably wouldn't have taken the fourth trade, which unfortunately would have been a pretty big winner. There was a big gap here. Trend trader probably didn't get short until somewhere in the 56 area. And honestly, they would have probably given it all back because you'll notice the market rallied from 42 up to 54. But it's reasonable to assume they might have made a few bucks here. But again, the peril of trend trading is you never try to pick tops or bottoms. You're trying to catch the middle. And sometimes at the end of a trend, it'll turn around abruptly and just take everything back. When I mentioned before, you have to have patience and discipline. That's exactly what I'm talking about. Most people wouldn't have had the discipline or patience to be into this trade. And even if they did, they may not have really benefited from it because their system would have been trailing the stop way up here, and they would have gotten stopped out at the worst possible price. The good news is a trend trader might have caught a big move here from 48 to 34. Now that's a huge move. You know, we're talking depending on where the entry was and the exit. I mean, you could have easily made 10 to 15 grand. So that's good news. But again, the whole point of this is, do you really think many traders would have gone through all of this heartache and pain to catch that 15 grand? I know I wouldn't have. I would have thrown in the towel long ago. That's why I'm not a trend trader. And that's why most people are just simply not equipped to be trend traders. My personality is better fit for swing trading. That doesn't mean yours has to be, but I'm going to tell you my argument and tell you why I think maybe swing trading might be a higher probability venture in the markets, at least for most of us. For those that don't have super deep pockets, you've probably heard of the turtle traders. They're infamous. Back in the 80s, they made a ton of money trend trading in the commodity markets. And the thing to keep in mind is they were very well capitalized. And when I say very well, I mean very well. And they weren't using much leverage. To give you an example of what kind of leverage they were using, it would probably be the equivalent of trading one E-mini S&P in a $200,000 account. I mean, not only were they not using leverage, they were actually using negative leverage. Most of us just do not have the money or the bankroll to do that sort of thing, and so we don't. And so we're not good trend traders. A trader that is kind of the opposite of a trend trader is Paul Tudor Jones, and he once said, "I believe the very best money is made at market turns. Everyone says you get killed trying to pick tops and bottoms, and you make all your money by playing the trend in the middle. Well, for 12 years, I've been missing the meat in the middle, but I've made a lot of money on tops and bottoms." And the reason for this is when markets top out or bottom out, they generally move quickly. They'll usually spike up to some sort of price extreme, and then they'll revert back to some sort of mean, and it happens fast. And so you can make some quick money if you happen to time it right. Of course, timing it right is not necessarily easy, but it can be done. So the question is swing trading a better strategy? I think it is, but again, this is just my opinion. The great thing about trading is there really is no right or wrong answer. Whatever works for your personality, whatever's more comfortable for you, because if you're comfortable, you're going to be making good trading decisions. If you're uncomfortable, you're going to be making bad decisions. And really, when it comes down to it, making or losing money in the markets it's a mental thing. It's emotional. So find what works for you and what works for your personality, and you're going to be a lot better off. I argue that swing trading is probably a better way to go about it than trend trading. Let's talk about swing trading and kind of get an idea of what exactly it is. Swing trading is the practice of identifying an overbought or an oversold market and trading against the trend. Again, we're doing what's uncomfortable, what's unnatural to us. It's basically the equivalent of buying fear and selling greed. When other people are panicking and they're selling a commodity, that's when a swing trader might step in and start buying. When other people are buying into a rally, think that crude oil or corn or whatever the market is will continue to move higher despite the fact that it's overbought, they're getting greedy. Well, that's when a swing trader might say, it might be time to fade this. So they're selling greed and buying fear. Swing trading is probably considered a relatively aggressive strategy because the idea is the traders are buying support and selling resistance. They're buying it when it seems like nobody else wants it, and they're selling it when it seems like everybody else wants it. They don't wait for any type of confirmation. Unlike trend traders who wait through a lengthy process of confirmation, swing traders are looking to pick tops and pick bottoms. It's not easy and probably shouldn't be done with too much leverage. It's nice to have some hedges in there also, maybe some long or short options to protect yourself, but money can be made on the turns if you happen to time it right. And as I'm going to show you in a few minutes, believe it or not, more often than not, trying to pick the tops or bottoms might work out better than trying to pick the trend, because markets spend most of their time trading in a range and only spend a little bit of their time making a new range, breaking out of that range. So the idea of swing trading is relative to trend trading. It comes with higher win percentage. You're going to win more trades than you're going to lose relative to trend traders, but you're not going to see the big, massive monster profits that trend traders make. So you're not going to catch the real big life changer like a trend trader might. But because of the manner of trading, you're not going to use as deep a stop. Risk per trade is probably going to be quite a bit less. And you're probably going to sleep a little better at night and maybe not experience so much emotional turmoil. But with that said, obviously, just as with any kind of trading, big losses are possible. In the case of swing trading, big losses are possible. If you're trying to buy support and support breaks, the market will break fast. Once it breaks through those technical levels, sometimes it seems like there's nothing stopping it. This is a pretty good example of exactly what I'm talking about. You'll notice that the market peaks out in this particular example anyway, and this is gold, by the way, the market tends to find a peak exactly when it seems like it looks the best, right? The market finds support on trend line and it bounces up to the upper end of the range. But a trend trader might look at this and say, well, that rally in gold from 1200 to 1350, that's confirming that the trend is now up. And a trend trader might start looking to buy at 1350. As we now know, because we have the benefit of looking after the fact, that would have been the worst time to buy. In fact, a swing trader might have looked at that and they might have seen stochastics were overbought. It was the beginning of a possible trend channel, and they might have sold into that rally. And you'll notice the market tends to come back into some sort of an equilibrium. So it gets overbought, and then it comes back to a normal price. And then it gets oversold, and it comes back to a normal price. In the end, the market is really trading in a pretty nice trend. If you draw a line through the middle, it goes to extremes every now and then. It might be Fed meetings, it might be non-farm payrolls, it might be something that sparks those moves, but they tend to prove to be temporary. And although this is a perfect example of a swing trading environment, they don't all work out this well, obviously. But I would venture to say that if you pulled up any chart, whether it's a day trading chart or a weekly chart or a day chart, you're probably going to get something relatively similar in most cases. Markets rarely break out and have big moves. They generally trade in a range. So the assumption of swing trading is that markets spend most of their time trading in a range and less of that time redefining that range. So with this in mind, more often than not, confirmation of a trend might also mark the end of it. And we saw that in the last slide. Once the last buyer, or once the last of those seeking confirmation of the uptrend is in the market has a tendency to reverse. And this is because it's kind of like if all the bulls are in and all the buyers have already acted, then the buying dries up. There's nobody left to buy. This is just another random example of a chart that shows you that markets do tend to trade in ranges most of the time, and then they spend a fraction of that time redefining the range, which in other words is a breakout or kind of a repricing. And this is exactly what swing traders strive for. They want a market that's essentially going nowhere, but bouncing between support and resistance, and more often than not, you'll find markets do that. Sometimes it's hard to take a step back and see that. When you look at a chart, it seems obvious after the fact. I mean, in hindsight's 20/20, right? But in the heat of the moment, when the S&P or the bonds or whatever it is you're trading is screaming higher, it feels like there's no end in sight. It feels like it's never going to stop and you should be buying. Probably everybody else or the majority of people are having the same thought that you are, and honestly that's probably the worst thing you could do. I've learned never to chase prices. I'd rather miss a trade altogether than chase a trade. I would much rather be on the sidelines wishing I was in than in the market wishing I was on the sidelines. And if you've ever been caught on the wrong side of the trade, you know exactly what I'm talking about. So let's talk about swing trading during news events. News is noise, but it might offer opportunities, and probably not the way that you think I'm going to say. Most people believe that they should put their trade on before the news comes out. They're looking for some sort of particular reaction to the news. They think that either they know more than the market does. Even if they don't necessarily think that, they think they can read how the market's going to react. And I can tell you one thing, markets rarely react in the way you think they're going to. Sometimes a bullish report comes out and the market sells off, and vice versa. It's impossible to judge what humans are going to do. I mean, the market is compiled, like market prices are basically the accumulation of all market participant opinions and reactions. Although we do tend to repeat ourselves over and over and create the same patterns, the exact reaction to any particular news event is really, it's nothing more than a crapshoot. But the great thing about it is, when a report, whether it's USDA or weekly inventory in crude, non-farm payrolls, whatever it is, when it does come out, the markets have a tendency to overreact, and then eventually a lot of times, not always, but a lot of times they will revert to some sort of a mean later on in the day or maybe the next day. So in other words, if a report comes out and the market, let's say corn, rallies 30 cents, chances are the next day or two, corn will probably retrace 10 or 15 of that. And that's what swing traders are looking for. So again, my opinion is swing traders are probably best off being flat going into the news in anticipation of entering a counter trend position against the knee-jerk reaction. I mean, you have to be careful with this sort of thing. One thing I've noticed is on payroll report Friday, you really generally don't want to counter trend trade late in the day. For example, let's say the non-farm payroll comes out in the morning, the S&P rallies 20 handles. If you see the S&P near some sort of resistance level, it's overbought, all your swing trading indicators are coming into line, then yeah, give it a go. Try to sell into that rally and see what happens. But as the day progresses, if the market hasn't started selling off, make sure you have some tight stops in, because eventually, if the market doesn't fade the news, is what traders say, it ends up continuing in the direction, and it continues, basically it ends up being a massive short squeeze. So there's lots of little rules that you'll learn along the way. Unfortunately, there's no way we could put them all in a single book or a single webinar, but we certainly try. Picking entry swing trading points. Okay, well, this is the million-dollar question. Where do you buy and where do you sell? So regardless of the technical analysis method that you decide to use for your trading, even regardless of the time frame, so if you're day trading, or if you're swing trading, looking to hold your position for 2 or 3 days, or maybe even longer term swing trading, a week or two, one thing is probably almost always going to be true. The more distant the support or resistance level from your technical analysis method from the current market price, the more reliable it is, but the less likely it is to be seen. So for example, if you're using pivot points, you may get 3 or 4 different potential reversal levels. The ones that are closer to the market are going to probably be seen frequently, but they're going to be less likely to hold or work out for you. The latter levels are going to be more likely to hold, but they're probably not going to be seen very often. So for instance, if you're a swing trader using intraday charts, let's say 30-minute bars, 60-minute bars, whatever the case is, and you're using the distance support levels and resistance levels, whether it's Fibonacci or pivots or whatever it is you're using, you're probably not going to see very many signals on the distant levels. In fact, you may only trade once or twice a week. If you're using the closer levels, the internal pivots, you might get multiple trading signals per day. So accordingly, those with sufficient funding might be better off scale trading. So for example, they might nibble at the first support, add on at the next support, and save plenty of ammo for the last support level. You always want to leave plenty of margin. You don't want to go all in on the first level, trust me, because like we said, the first level is going to be less reliable than the next, and the next will be more reliable than the former. So keep that in mind as you're going. If you're working with limited funds, if you've got a smaller account and you don't have the margin to scale in and add on, first of all, trade markets with low margin, so you have the freedom to scale. But if that's not a possibility, wait for the best signals. Wait for the levels that aren't going to be seen very often, but are going to give you the higher probability trades. So be patient. Like I said before, I'd rather be out of a market wishing I was in than in a market wishing I was out. So this is just a random chart of something a trader might be looking at. Aggressive traders can nibble on the higher support levels, but the most reliable and the less likely to be seen will be the lower support levels. So if you're a conservative trader, make sure you're holding out for those lower levels. And again, this can be regardless of your strategy. Some of you might be using trend lines, that sort of thing. Some of you might be using Fibonacci. Whatever the case is, make sure you save ammo for the lower level, or be patient. Don't trade unless you get to the final level of support. That's where you're going to have your best opportunities. Now, the difficult thing about swing trading is knowing the difference between a correction and a trend change. Unfortunately, we never really know that for sure until after the fact. I wish we did. Life would be a lot easier if we knew in advance when the trend was changing, or if we were just in a run-of-the-mill correction. Swing traders are typically looking to take a piece of the retracement and will never catch an entire move. That's just the nature of the trading method. I mean, obviously it would be nice to catch the whole move, but if you're trading in a manner that does catch a big trend, then you're probably not swing trading. You're probably using deep stops. You're probably doing things that swing traders normally wouldn't do, which is fine. You don't have to be necessarily only a swing trader or only a trend trader. Maybe you're going to combine those strategies together and come up with something that you find that works best for you. That's okay too. But generally speaking, a swing trader will look to exit most of their position prior to determining whether the trend has actually changed or not. So for example, if the market you think the market's expensive and you sell a market and it starts to pull back a little and you're profitable, chances are you're not going to necessarily trail your stop, although you could. But if you're sitting on a profit, let's say just hypothetically, you're a day trader and you sell into a rally and you're making $500, you might be saying to yourself, that's not such a bad day. I think I'll take that and move on, as opposed to placing a stop and trying to catch a bigger move. If it isn't a true trend change and it is just a run-of-the-mill correction, you might end up giving most of your money back. So if it does turn out to be a full-on trend change and you've already exited but you left a lot of money on the table, don't fret. That's the strategy. You wait for the next signal. And it might even be going the other way. So maybe you missed out on 10 points in the S&P on the downside, but guess what? You look for a place to buy. The idea of being a trend trader is basically looking for base hits. You're not trying to hit home runs. Hopefully base hits will win the game. Swing traders really don't require a trend change to make money. What they simply need is a corrective move. And the idea is when the market does go in your favor, when it does finally correct and you happen to have put your trade on, hopefully you did it at the top or the bottom, but if you got anywhere in the vicinity, you should be pretty good. The first thing you want to do is throw a stop in there or buy an option or do some sort of risk management that will ensure that you either at least don't lose money or, hopefully lock in a small profit. And again, this is another example of buying when the market looks the worst and selling when the market looks the best might turn out pretty well for you. You'll notice the indicators at the bottom, we're using RSI and W%R, which is Williams %R. Both of these are trigger indicators. I talk about this in my book, Higher Probability Commodity Trading. You can use other indicators. I think that most indicators really in the long run will perform about the same. But the reason I like RSI and W%R is they're on two different time frames. The RSI is going to give you fewer signals, but more reliable signals. And the %R is going to give you more signals, but maybe not quite as reliable. The %R tends to be a little early sometimes. Sometimes it'll give you false signals altogether. But if you put these two together, you can usually come away with some pretty decent trading signals. Day traders should be willing to swing trade. Now, this is an interesting concept. Most people, when they talk about day trading and they decide to be a day trader, they kind of put themselves into a little box and they have a hard time thinking outside of that box. Try not to define yourself as a certain type of trader. Swing traders are sometimes day traders that just got stuck in a trade. They're stuck in a losing position, but the signal is still valid and it's worth hanging on to. In that case, rather than getting out at the close like everybody else is, you may want to consider holding on your position through the close and getting out later that afternoon or early that evening. So I'm not saying you necessarily have to go to sleep with your trade on, because I know that's the whole point of day trading. You don't want to do that. But what's the harm if you hold it, if you're trading the E-mini S&P, the electronic session closes at, well, the official day session closes at 3:15 Chicago time, but then it trades for another 45 minutes after. Or actually, it closes for 50 minutes and then it reopens. It's kind of complicated unnecessarily. But to simplify, then it closes again at 4 o'clock, 4 p.m. Central Time. So what's the harm in holding it beyond the 3:15 close and probably even beyond the 4 o'clock close? Maybe you want to get out at 6 or 7 in the evening after the Asian markets have opened or the U.S. markets have, or I should say the U.S. futures markets have had time to kind of digest things. There are a lot of day traders in the markets, and I'm not talking just the E-mini S&P, the SPY is the same, individual stocks are the same. There are a lot of day traders that know that they have to get out by the close. So when the market goes into a short squeeze, the market continues to move higher regardless of fundamentals or charts or anything like that. And the reason being because people are buying to get out because they have to, because they don't have the margin to hold overnight. They're not buying because they want to, they're buying because they have to. Don't put yourself into that group. Don't get stuck in a trade and have to get out with everybody else. Hang on to it. Make sure you have enough margin in your account to hold it overnight if you need to. And again, when I say overnight, I'm not necessarily meaning get up tomorrow morning and get out of your trade. I'm saying just hold it beyond the close of the day session. Futures trade 24 hours. You can get out of it in the evening. And a lot of times you'll notice, particularly the E-mini S&P, when it reopens at 6 p.m. Chicago time, if there was a short squeeze going into the day session close, the night session will open up 2, 3, 4 points lower just on the relief of the rally. So the bottom line is don't let time determine your strategy. Let your strategy determine time. So don't get out of the market at the close just because you think you're a day trader. Let your strategy tell you when the signal's over, when it's either not working or working. Let your strategy determine when you get out. So how many times have you seen a market, and again, particularly the E-mini S&P, trend all day, finish on the highs, and then retrace overnight? It happens all the time, and it's terrible because a lot of the people that put themselves into that day trader box end up buying the highs, and then the next morning they come in and the S&P is down 10, and they could have at least gotten out at break even or maybe even made a little money on their trade, but instead they got out with everybody else on the close. So in other words, somebody that's willing to hold overnight is basically transitioning from being a day trader to being a swing trader. The biggest challenge in the switch is probably an emotional one. If you can't sleep at night with open positions, swing trading it might not be for you. Or make sure you have hedges on. Make sure you put in your stops, or I actually prefer using options, and that might mean buying options. In the E-mini S&P, you can buy or sell weekly options, preferably buy if you're using the weeklies, but you could sell options to hedge your position. So there's a lot of ways to reduce your overnight risk, or if you're the type that prefers using stops, you could do that too. I'm not a huge fan of stops because they generally get filled at the worst time right before the market goes in your favor, so be careful with that. But all I'm saying is, even if you are a day trader and you want to use swing trading signals, make sure you have the ability to hold overnight, and you're willing to hold overnight at least into the night session, not all the way to next morning necessarily. So swing traders, as opposed to day traders converting to swing trading, typically expect to hold positions overnight. Most swing traders are looking to hold a position for 1, 2 to 3 days. Some do more, but generally you're looking for a couple of days, and that's the idea of it. Maybe even a couple of weeks if you're more of a position type trader, depending on the signals you're using and the chart time frame you're using. But again, I just want to reiterate, the markets might be on timers. There are open and closing time to the market, but there aren't to strategies. Strategies do not have open and closing time. So if you really want to give your strategy the chance to work, make sure you're not ruining it by getting in and out at specific times, because strategies and markets are not timed. They don't care about time, they care about price. Whether you are a day trading swing trader or a position trading swing trader, you must know margins and how they work. I know this is a little boring, but trust me, this can save your trading account, just knowing the little things. Most traders don't fully understand margin details. Here's how it goes. Overnight margin, that is what is needed to hold a position beyond the close. And this is set by the exchange. It's non-negotiable. If you look at a margin sheet and you see the initial margin, that's what I'm talking about when I refer to overnight margin. You might also see a maintenance margin level, which for our purposes, I'm going to say it's relatively irrelevant, but in a nutshell, what maintenance margin is, it's about 10% below the overnight margin or the initial margin. And it's the level that the exchange sets in which margin calls will be triggered. So if your count drops below the maintenance margin level, you get a margin call. Day trading margins, which are applied to anybody that is entering and exiting trades within a single trading session. Now, this is kind of an ambiguous topic, and the reason being, it really depends on which brokerage firm you're trading with as to what the day trading margin hours are. For our brokerage, we allow our clients to have day trading margin access, which is basically a discounted margin, as long as they are out of the market by the close. And so that means they could put a trade on in the overnight session, hold it overnight, and then get out the next day and be fine. That's considered a day trade. Some brokerage firms will charge you full overnight margin if you try to get in during the night market, but they'll begin charging you day trading margin at some point in the morning, usually around 8:30 a.m. Central Time, but again, it depends on the brokerage. So in its simplest form, day trading is when you get in and out of a position in the same trading session and you're given a discounted margin rate. It really depends on the brokerage firm as to how low that margin might be. It's relatively negotiable at most brokerage houses, but it's generally about half of the overnight margin. So for example, if crude oil margin right now is $3,800, you're looking at somewhere around $1,900 to day trade crude oil at most brokers. Some brokers will give you a lot cheaper margin than that. Some brokers will give you, for example, in the E-mini S&P, that's a commonly highly discounted margin rate. Our brokerage gives you $500 day trading margin on the E-mini S&P. I highly recommend that you do not use that type of leverage. I think that if you're going to day trade the E-mini S&P, you need a lot more in your account than $500 to $1,000 or whatever it is. But with that said, it is available. A lot of brokerage firms will do it because it encourages people to trade more, and they make more money the more people trade. And so that's really as simple as it is. However, they also know that the lower the day trading margin, the higher the leverage, the more likely it is for their clients to blow out and lose a lot of money. But unfortunately, they still offer them. Margin is only levied by the exchange once a day, and that's at the close of trade. So any position that's held at any other time other than the close is considered a day trade. So again, in theory, if you bought an E-mini S&P tonight, you could hold it all the way through to tomorrow morning and get out by tomorrow afternoon close, and that's still considered a day trade. So what I'm trying to point out is a day trade has nothing to do with what day you're putting it on. Like a lot of people think that today's Wednesday or Thursday or whatever the case is, they're entering the trade on Thursday night and they're exiting on Wednesday. So they don't think that is counted as a day trade, but it is. Anything put on in the night session is good for the next day's business. Same manner, if you buy an E-mini S&P on Wednesday night and you sell it on Wednesday night, that is considered a day trade. But if you buy it on Wednesday morning and you sell it at Wednesday night, that is not a day trade. Those are actually two different trading sessions. It gets a little more complicated if you're swing trading and you're tight on margin. There is something you need to know. The exchange will measure how many contracts you have open at the close of the electronic trading session. So we'll just say in the case of gold and silver, this happens a lot. The gold and silver pit closes at 1:25 Eastern time, but then it trades all the way through 5 p.m. Eastern time. So that's almost 4 hours for the price of gold and silver to change. A lot can happen in gold and silver in 4 hours. So it's interesting that the exchange will measure how many contracts you have at the 5 o'clock close, but on the statement, they'll settle the gold and silver prices at the 1:25 close. And sometimes we're talking thousands and thousands of dollars of difference in people's account balance. But then their margin is levied based on that day session close. So you really have to be careful with that and understand that the day session close is the price that's going to be on your statement as far as your settlement, and that's going to determine what your open profit and loss will be, and in turn determine what your net liquidation value is going to be, and that's what your margin calculations are based on. So be aware. Do stop loss orders do more harm than good? And this is probably a concept that you've read in every book you've ever read on trading. You've probably heard about it in every webinar you've watched. The conventional wisdom suggests that you should always place stop orders. And most people believe that placing stop orders is the best way to manage your risk. Don't get me wrong, it's a very popular way to do it. But I don't think it's necessarily the most efficient for all traders. Most traders have experienced the torture of being stopped out of a market just before it moves in favor of the trade. And trust me, you're not alone if this has happened to you. For whatever reason, it's Murphy's Law. Markets tend to run the stops, and then they reverse and go the other way. Markets like to cause the most amount of pain to the most amount of people, and that's one way it does it. So are traditional stop orders helpful? Well, stop loss orders are intended to be a risk management tool, but I argue they might do more harm than good in some cases. For instance, some traders are only willing to risk $50 to $100 per trade, and that sounds like a good thing on paper. I mean, think about it. If you can only lose $100 per trade by placing a tight stop loss, but you have theoretically unlimited profit potential, it seems like a good deal. But the reality is you're almost always going to get stopped out if you have a tight stop. It's almost just like you might as well shred your money. And those small losses add up to large losses pretty fast. So markets are volatile. Stops tend to be elected at a loss, even if the trader's idea was right. This is frustrating. If you're bullish a market and you go long a future and you place a stop, the market stops you out, and then the market moves higher without you. It's extremely frustrating, and unfortunately that frustration will bleed into your future trading decisions, so it's really just a no-win situation. Imagine being stopped out on the Thursday night before the Brexit vote. I don't know if any of you were watching, but the E-mini S&P rallied up to 2120. The blink of an eye, it dropped like a rock, and I can guarantee you that there were some stop losses up there, because at the time that was a new all-time high. Guess what? Everybody likes to put their stop, above the old swing high, thinking that if it goes up there, then it's bullish and it's going to continue higher, and that's really not always the case. A lot of times they'll run some stops and turn around. And this is just an extreme example of that. But I can imagine a trader in this situation that had a stop anywhere between 2110 and 2120 in the S&P. They probably lost a few bucks. obviously depending on their entry, but I would guess they probably tried to go short somewhere around 2100, so they could have easily lost 500 to 1,000 bucks. But look what they missed out on. Not only did they lose 500 to 1,000 bucks, the market immediately turned around and would have made them anywhere from $5,000 to $6,000. Now, this is a rare situation. This doesn't happen often to this magnitude, but the concept happens all the time. It's just not usually this dramatic. So there are alternatives to stop orders. You can protect yourself without actually placing stops. For starters, you could use a mental stop, but not everybody is capable of pulling the plug on a bad trade, and I totally understand that. And plus, you sleep at night, and anything could happen while we're sleeping, so you want to make sure that you don't wake up to a disaster. So the other alternative would be options, buying options as insurance, or you could actually sell premium around the futures to lower your delta. Unfortunately, we can't really get into that in the scope of this particular class, but I cover it in my new book, Higher Probability Commodity Trading. And, I talk about it in a lot of presentations that I do, and we talk about it on our website. So the idea is, if you're selling a futures contract, instead of placing a stop-loss order, which would protect you from a rally or an adverse price move, you could buy a call option. Now, you don't want to spend a lot of money because options are an eroding asset, and options are expensive. They're not cheap, just like insurance, our car insurance or our home insurance is not cheap, but it protects us. That's exactly what an option will do in the futures market. You go short a future, you buy a weekly option for cheap, and there you go. You're in the market in a swing trade for 2 or 3, 4 days, and depending on the situation, you can probably buy that protection for 500 bucks or less. So your total risk is 300 to 500 bucks. And you have unlimited profit potential on your futures. You can sleep at night, and the best of it all, there's no chance of getting prematurely stopped out. No matter how far the S&P goes against you, you're still in the trade. Now, your trade might be losing as the market rallies. If you're short the future, you're losing on the future. You're making money on your call. So all in all, you're probably losing money, but it doesn't matter if the market goes to 2110, 2120 to 2200, you're still in the trade. If it turns around and comes crashing down, you still have a chance to make money on it. So in a nutshell, buying options against a futures position is basically lasting power without unlimited risk. So it gives you the ability to ride the ebbs and flows. You no longer have to watch the market stop you out and then go your way. If it goes your way, you're still in the trade. Another alternative to hedging with futures is to sell options against your futures position. So this would be the opposite idea. If you're long a future, you would sell a call. It's not unlike covered call strategies that you read about in the stock market. But the opportunity cost of selling options against your future is the loss of potential futures market gains beyond the option strike price. So the nice thing about selling an option against your future is it hedges your risk. It brings in premium. That premium that you bring in gives you a cushion against adverse futures market moves, but your profit potential is limited. The most you could ever make on a covered call situation is the premium that you collect, plus any difference between your futures entry price and the strike price of your option. So again, this gets a little bit complicated, but I just want to kind of throw this idea out to you, and if you want to learn more, you can check out our books or check out some of our other classes. So this is an example in crude oil. In this situation, crude's hovering around the $43, $44 area. Let's assume that a bullish trader might go long a futures contract at 44. He could then sell a 44 call option for $2.50 in premium. This is basically 2,500 bucks. The result is a trade that makes money as long as the price of crude oil is above $41.50. And the reason that is that $2,500 that was collected on the option acts as a buffer on the downside. So if we're a little wrong and crude oil goes down from our 44 entry, as long as it's above $41.50 at expiration, we make something. Now, the great thing about this is for us to keep that entire $2.50 in premium, which is $2,500, the only thing that has to happen is the price of crude at expiration has to be above 44. It can be 44.01 or it can be $50 a barrel. It really doesn't matter. We get to keep that 2,500 bucks as long as the price of crude is at 44.01 or higher. Not such a bad deal. Now, the downside is you're giving up the upside potential. If crude does go to 50, instead of making 6,000, you're only making 2,500 bucks. So that's a bummer. But the idea is your odds of success are so much greater because you can give yourself a $2.50 cushion in being wrong. You can be wrong by $2.50 and still make money. You can do the same thing with a put option. This is an example of a gold trade that came up, a hypothetical gold trade a couple of months ago. A trader that's bearish gold could dramatically increase the odds of success in selling a futures contract by selling a put as a hedge. The great thing about gold is the options are very expensive. So if you're an option seller, it's extremely attractive. Now, the thing to keep in mind is options are expensive for a reason. Gold options are priced the way they are because gold can move quickly and it can be dangerous if you happen to be in the wrong place at the wrong time. So don't feel like it's free money, because it's absolutely not. You're accepting some risk. But in this situation, it seems like a pretty high probability trade. You could sell a gold futures at $13.70 and simultaneously sell a $13.70 put and bring in $5,000 in premium. This equates to $50 in gold. So gold could go up $50 and you'd still be breaking even. In fact, your break-even point at expiration is $14.20. So at expiration, if gold is $50 higher than where you entered, meaning you were wrong, the market went up $50, which is pretty substantial, you're still just breaking even. It's not so bad. If you happen to be right and gold is anywhere below $13.70 at expiration, you get to keep $5,000. Gold might only be at $13.69. That's okay. Still make $5,000. The downside is, of course, if gold drops $100, you're only going to make $50. You're only going to make that $5,000 that you collected for the option. You're not going to make anything below that. So anything below $13.20 is just kind of money that you left on the table. But I think we'd all agree that's worth it, because the odds of gold dropping more than $50 aren't necessarily great, but the odds of the gold simply staying below $14.20 are pretty good. The only way you can lose money is if gold is above $14.20 at expiration. Here's an example of buying an option to protect your futures trade. This is in the E-mini S&P, so a trader that's going short a futures contract at 2056 could buy a 2055 call for about $12. This is hypothetical, but when I took this example, these were pretty realistic prices. This particular option expired in 3 days. It was a weekly option. So for $550, this trader gets 3 days in the market with absolute risk. The most he could ever lose is $550. His profit potential, on the other hand, is theoretically unlimited. The thing to keep in mind when you're buying options is insurance. Of course, they're not free, and so, of course, for you to make money on the trade, you have to recoup what you paid for that option. Roughly $550 is what you have to recoup. So the break-even point is 2044. As long as the market's below 2044, you start making money. Anything above 2044, you're losing anywhere from $550 and down. And it's not such a bad way to go about it, because, like I mentioned, you don't have to worry about getting stopped out. If you sell the future at 2056 and you have that call option protecting you, the future can go all the way up to 2120 and come back down, and you're still in the trade. So in conclusion, I just want to kind of summarize what we've talked about. Trend traders face deep risks per trade and relatively low odds of success compared to swing traders. Swing traders should let the market dictate the time horizon. They should not let market open and closing time dictate their trading strategy. In my opinion, if the market gives you a gift, you take it. It isn't necessary to stick around long enough to determine if the move is a trend change or a correction. If you're sticking around waiting to see if the trend truly has changed and the market's going to continue in your direction, you're probably getting greedy. If you put on a swing trade and it makes money for you right away, make sure you put in your stops, or you put in an option to protect it, or exit the trade. Make sure you lock something in. Never turn a winner into a loser. That should be the #1 rule. Understand and strategize margin implications. Be aware of day trading margin, be aware of overnight margin, be aware of when your broker will allow you to utilize day trading margins, and know how margining works. Options offer unlimited options for managing futures contract risk. Don't be afraid to be creative. Options are extremely versatile. In this video, we simply skimmed the top of these subjects. If you're interested in learning more on using options to hedge futures, or putting together strategies for day trading, swing trading, learning about the perils of trend trading, or maybe even the advantages of trend trading, check out our new book, Higher Probability Commodity Trading. Again, it's available on Amazon or any other book outlet. We appreciate your support, and we hope that you visit our webpage, decarleytrading.com. We have several trading videos and multiple educational articles on the site. We are a brokerage, so if you're looking for a good commodity broker, please keep us in mind. We'd love to have you. We offer everything from full service to discount online trading, and I think you'd be surprised at what we can provide in regards to market news, commentary, trading ideas, and just quick and efficient support. If you have any questions or if there's anything we can do for you, give us a call, 1-866-790-TRADE. That's 1-866-790-8723, or send me an email, and I hope to see you on Facebook and Twitter.